All right, so Circle just dropped their latest earnings report, and it's pretty wild. You've got the first ever publicly listed stablecoin company, and they're basically telling the world, yeah, profits, we're not too worried about those right now. It's a huge bet, and it shows they're playing a completely different, much bigger game. I mean, this quote really just lays it all out there, doesn't it? For Circle, things like profits or losses, they're just minor details at the moment. The real lifeline, the thing that matters above all else, is the ecosystem. Everything, and I mean everything, is being sacrificed for that one goal. Okay, but hold on a second. Can a public company really just ignore profits? I mean, that's kind of the whole point, right? You're responsible to your shareholders. So how on earth do you justify this to Wall Street? It's a super bold move, and honestly, it's got the market completely split. So let's dig in and figure out what's actually happening here.
So first up, we've got Section 1, growth over profit. A pretty radical strategy, to say the least.
All right, Section 2, the market's 3 doubts. Because a strategy this aggressive, well, it definitely comes with a price. And that price is a whole lot of doubt from the market, which is putting a serious chokehold on their valuation. So doubt number 1, is the growth potential even real? Look, nobody's debating that the stablecoin market is going to be huge. We're talking trillions with a T. But the big question hanging over Circle is, how much of that giant pie can they realistically get their hands on? And here's why investors are nervous. The total addressable market is absolutely massive, but they're all looking ahead to when this big Stablecoin Act passes. And when it does, the floodgates are going to open. You'll have all sorts of new, heavy-hitting competitors jumping in. So for a conservative investor, that future is just too uncertain. They're slapping a huge, high-risk label on Circle, and that's pushing its valuation way down. Then there's doubt number 2. Is this aggressive expansion just, killing their profits? They're pushing so hard to get USDC everywhere, on every exchange, in every wallet, and the market's starting to wonder, are they just burning through piles of cash for a future that might not even pan out? Yeah, the worry is pretty simple. All these new partnerships and all this new infrastructure, it costs money. A lot of money. And investors are afraid that it's going to cause a really significant and painful hit to their profits in the short term. It's a classic growth versus profit dilemma, but for Circle, it's all happening out in the open. And now for doubt number 3, and this one might be the scariest of them all. The big one. Does Circle's entire business model have a fatal flaw? Because when you look under the hood, their main way of making money is shockingly fragile. And investors have definitely noticed. Okay, get this. A whopping 96% of their revenue comes from just one thing: interest on their reserves. And it gets worse. Of that interest income, they have to share almost half of it with Coinbase. So think about it. What happens if interest rates fall? Their entire revenue model just craters. It's a massive, massive vulnerability. All right, so moving into Section 3, Circle's strategic answers. We've heard all the doubts, so how is Circle fighting back? Well, they use their latest guidance to address every single one of these fears head on. First up, to tackle that unclear growth doubt, they put a hard number out there. A target of 40% compound annual growth for USDC circulation for the next few years. Now, whether they hit that exact number is almost beside the point. The real magic here is that they're giving the market clarity. They're reducing that fog of uncertainty, which helps investors feel more comfortable and hopefully shrinks that big risk discount we talked about. Okay, what about the worry that expansion is hurting profits? Well, their answer was to guide for stable margins. And you might be wondering, how is that possible if they're expanding so fast? The key is that their new big partnerships, with companies like Visa and OKX, are mostly non-revenue sharing deals. So they get to grow the ecosystem without cutting into their own profits. It's a smart way to calm those fears. And finally, how do you fix that potentially flawed business model? You diversify fast. Their guidance shows that what they call other revenue, this is stuff like their Web3 services, APIs, custody fees, is set to grow by more than 4 times this year alone. Now, it's still a pretty small slice of the overall pie, for sure, but it sends a crystal clear signal. We know this is a problem, and we are actively fixing it. Okay, so Section 4, a race against time. Because even though the strategy sounds pretty solid, when you look at the data, you realize the pressure is immense. Circle is in an absolute race against the clock. And here's the first sign of that pressure. Look at the market share change in Q2. The top two stablecoins as a whole actually grew, but USDC's individual share, it actually slipped by 1%. Now, 1% might not sound like a lot, but in a race this tight, it's a huge warning sign that the competition is heating up. This is why that expansion is so critical. If you look at where USDC actually lives, you can see Circle is still super reliant on its partners. You've got a massive 68% on places like Binance and another 23% on Coinbase, where, remember, they have to share the revenue. Their own internal share, the part they control completely, is growing. It's almost at 10% now, but they've still got a long, long way to go to bring more of that home. But there is a really positive sign, and it comes down to this one number, 5.7 million. So what is that?
That 5.7 million, that's the number of MEWs, or monthly engaging wallets. Basically, you can think of these as real, active people using USDC. And this might be the single most important number to watch. Why? Because it's not just big, it's accelerating. It's growing faster and faster. This tells you they're getting deep user adoption, and the more that number grows, the stronger and more defensible their ecosystem gets.
Okay, so let's zoom out. Section 5, the ecosystem is everything. When you put all these pieces together, the strategy, the doubts, the race against time, it all points to one single critical truth about Circle's future. That truth is that their window of opportunity is closing, and it's closing fast. See, right now, their biggest competitive advantage is that they've been so focused on compliance. It's their moat. But the second that Stablecoin Act passes, that moat pretty much disappears. The playing field gets leveled, and all that hard work just becomes a head start. They absolutely have to use the time they have right now to build a different kind of moat, an ecosystem moat, before everyone else shows up to the party. Because at the end of the day, this is a platform game. It's a winner-take-all, or at least a winner-take-most kind of market. Once the dust settles, there are only going to be a few of these platforms left standing. And this really is the most important takeaway from all of this. Think about it. A flawed business model? You can fix that later. If your ecosystem is big enough and sticky enough, you'll figure out a way to make money from it. But a lost race for market share? You can't fix that. You don't get a do-over. Once users are embedded in someone else's ecosystem, getting them to switch is almost impossible. And that is why, for Circle right now, the ecosystem isn't just the main thing, it's the only thing. So it all comes down to this. Circle is placing an all-or-nothing bet. They're trying to build this impenetrable fortress of an ecosystem before the competition even has a chance to lay siege. You can always strengthen a fortress, but you can never, ever rerun a lost race. And that leaves us with just one question. Will they be fast enough?